QQQ's 125% return crushed VV's 83%. But here's the catch. You'd endure a brutal 35% drop versus VV's gentler 26% slide. Over 5 years, QQQ's 102% crushed VV's 92%. But that 10-point gap shows they're closer than you'd think long-term. But here's where it gets interesting. QQQ absolutely crushed it over 3 years, with that 125% return, the kind of performance that separates winners from the pack. Let's zoom in on this. VV's 83% 3-year return tells us it's significantly lagged behind. That gap means real money left on the table for investors. In plain English, here's QQQ, finishing 50% ahead over 3 years, like watching a Formula One car race against a sedan. Same market track, but tech's engine just runs hotter. Here's where the story takes a turn. QQQ's 5-year return of 102% is still impressive, but notice how that lead's starting to narrow over longer time frames. Let's break this down further. VV's delivered 92% over 5 years, nearly caught up with just a 10-point gap remaining after half a decade. In plain English, here's the long-term picture. QQQ sprints out front like a marathon runner chasing the lead, while VV maintains that steady, relentless pace that gradually closes the gap over time. Returns tell you where you ended up, but risk-adjusted returns show you whether the bumpy ride was actually worth taking. Let's dig into the details. Both funds tie at 0.8 on 1-year Sharpe ratio, delivering identical risk-adjusted returns over the short term here. Here's where things get revealing. QQQ's 1.3 Sharpe ratio shows you're getting solid returns without taking crazy risks. That's the sweet spot investors hunt for. Now let's put this in perspective. VV's 1.2 Sharpe ratio over 3 years came remarkably close, just 1/10 of a point shy of matching the benchmark. In plain English, the Sharpe ratio is your efficiency meter. It shows how much return you're squeezing out per unit of risk. Think of it like an amplifier knob. Higher settings mean better bang for your buck. Here's the thing though. QQQ's 1.8 Sortino ratio shows it cushions downside risk well. You're getting solid returns without brutal crashes when markets turn south. Let's take a closer look. VV's Sortino ratio hit 1.6 over 3 years. That's strong downside protection while still delivering solid returns for real investors. In plain English, Sortino's like watching a storm brew. It only measures the downside drops, ignoring upside swings. Think of it as bad weather insurance. QQQ handles those downpours slightly better than the competition. But that's not the whole picture. Now we're getting to the painful part. Maximum drawdown measures your worst peak-to-trough loss when concentration bites back hard. Let's see how this plays out. A 35% drop means watching 100 grand shrink to 65. That's the pain you'll face when QQQ crashes. Here's what really matters. VV's worst drop was just 26% over 5 years. That 9-point cushion really matters when you're watching your money fall. In plain English, maximum drawdown's the biggest drop from peak to trough. Think of it like a roller coaster. QQQ's got the steeper plunge, while VV's scary drop isn't quite as gut-wrenching for your portfolio. But hold on a second. 405 days to break even? That's over a year watching your money just sit there going nowhere. Let's unpack this a bit. All right, pause here. Who's your pick? QQQ or VV? Drop your vote below. Here's the key takeaway. VV's slower recovery reveals a hidden weakness, taking over 1 year to bounce back despite experiencing a smaller drawdown than QQQ. In plain English, VV's smaller drop actually took more time on the clock to recover from. It's not just about how far you fall. Sometimes it's about how fast you can climb back up. But there's a catch. Volatility is the real difference maker here. It shows you how wild the daily swings get, and trust me, higher volatility means rougher rides. Let's get into the weeds here. QQQ's 23% volatility means you're riding serious price swings. That daily turbulence adds up to real investor stress. Now let's shift gears and look at VV's calmer ride at 17% volatility means 6 percentage points less daily drama than its competitor. Smoother sailing for your nerves. In plain English, volatility is the real test of your stomach. QQQ's like riding a stormy ocean with massive waves, while VV's smoother sailing keeps you from getting seasick watching your portfolio. Let's zoom in on this. QQQ's wild swings? It's all about concentration risk. When you've got fewer stocks, every single move hits way harder. But here's where it gets interesting. QQQ's laser-focused on just 102 stocks. That's way more concentrated than most ETFs, meaning bigger bets on fewer winners. Here's where the story takes a turn. VV spreads your risk across 456 stocks. That's over 4 times more diversification, cushioning you against any single company's collapse. In plain English, QQQ concentrates your investment into just 102 companies, while VV spreads across 456. It's the classic egg basket dilemma. More baskets mean one company's collapse won't destroy your portfolio. Let's zoom in on this. Beta's your sensitivity meter. Higher numbers mean you're riding bigger waves, both when markets climb and when they crash. Now for the real question. QQQ's 1.2 beta means it swings 20% harder than the S&P 500, amplifying both your wins and losses. Let's dig into the details. VV's beta of exactly 1.0 means it mirrors the S&P 500 perfectly. When the market moves, VV moves with it. Here's where things get revealing. QQQ delivered stronger returns at 125% over 3 years. But you're paying for that with wilder swings, 23% volatility, and a brutal 35% drawdown, versus VV's calmer ride. In plain English, beta's your amplifier knob for market swings. QQQ cranks it to 120%, so when the market moves, you're feeling 20% more of it. VV keeps things neutral at 100%. But wait, there's more to this story. Correlation shows how tightly a fund mirrors the S&P 500. Perfect tracking means a correlation of exactly 1.0. Here's the thing though. QQQ's 0.9 correlation to the S&P means they move together closely, but there's still room for some independent swings. Let's take a closer look. VV's perfect 1.0 correlation means it's basically the S&P 500 in disguise. Every move the market makes, VV mirrors it exactly. In plain English, here's the dance partners analogy. VV mirrors the market perfectly, like a synchronized duo. QQQ, it's got its own flair, adding independent moves while still following the rhythm. But that's not the whole picture. Fees might seem tiny today, but they're silently compounding against you, stealing wealth you'll never see in 30 years. Let's see how this plays out. 20 basis points a year. That's pretty cheap for an ETF, leaving more money working for you instead of fees. Here's what really matters. VV's 0.04% expense ratio is 5 times cheaper than QQQ. That's serious savings compounding in your favor over time. In plain English, think of expense ratios like couch change you're losing. QQQ charges a nickel per 25 bucks, while VV only takes a penny. Small fees compound big over time. Now, QQQ's tech-heavy lineup isn't accidental. It's the entire strategy, and that concentration shapes everything about how it performs. Let's unpack this a bit. QQQ's putting 53% of your money into tech. That's a massive bet on one sector's performance. Here's the key takeaway. VV cuts its tech exposure to 35%. Still significant, but way less concentrated than funds betting everything on one sector. In plain English, here's the pizza comparison you need to remember. QQQ is serving you more than half tech, while VV keeps it lighter at just over a third. Big difference in your tech exposure here. But there's a catch. QQQ's tech obsession means no financial cushion. VV's balanced approach? Those boring bank stocks actually protect you when tech crashes hard. Let's get into the weeds here. QQQ's essentially ignoring banks entirely. That tiny 0.29% means you're betting almost everything on tech, not traditional finance. Now let's shift gears and look at VVV, puts 13% into financials. That's 45 times what QQQ offers, giving you real exposure to the banking sector. In plain English, here's the seesaw analogy. QQQ's all tech, no balance. VV's got one foot in tech, the other in financials. It's diversification you can actually picture. Let's zoom in on this. Every fund has that one golden year. Now we're looking at each fund's absolute best performance on record. Here's where the story takes a turn. QQQ's best year hit 55%. That's tech concentration firing on all cylinders, when innovation takes off and markets reward it. Here's where the story takes a turn. VV's best year hit 33%, solid gains, but it couldn't match QQQ's 55% peak performance by a wide margin. In plain English, QQQ's like a fireworks burst. Explosive gains when markets ignite, but unpredictable. VV? Think steady fountain fireworks, controlled, reliable, won't leave you ducking for cover when things go sideways. Let's break this down further. QQQ chases tech's explosive gains, but crashes harder. VV plays it safer with broader diversification, trading upside potential for steadier performance. Now for the real question. QQQ's 125% three-year gain and 55% best year show what happens when you bet big on tech during growth phases. Let's dig into the details. VV's 26% drawdown beats concentrated tech funds when markets crash. That 17% volatility means you'll sleep better during downturns. In plain English, here's the egg basket analogy in action. QQQ concentrates on tech for bigger potential gains, while VV diversifies across sectors for smoother, steadier returns. Your risk tolerance picks the winner. Now let's put this in perspective. Over 5 years, VV's diversification and lower fees help it nearly catch up. Just 10 points separate them now. But wait, there's more to this story. So which ETF's your match? QQQ, if you're chasing maximum growth, VV, if you want something more balanced long-term. In plain English, here's your car engine analogy. QQQ's turbocharged tech motor gives you thrilling speed, but demands skill-handling sharp turns. VV's all-purpose engine? Smooth, steady, reliable for the long haul without drama. Let's take a closer look. Legal stuff matters. Do your homework and consult pros before putting money anywhere. Now here's where it gets tricky. If you enjoyed this ETF breakdown, hit subscribe now for weekly data-driven analysis to sharpen your investment game.